Hey everyone, Dalton Grados with Grados Capital here, and today is my last newsletter for 2025. Now, I know I haven't posted a video in a little while, but I do post my newsletter every single week, and the past few weeks it's been in written form, and you can get that at the first link in the description on Substack. It's totally free, no upsells, just a Substack subscription sent to your email every week, whether it's in video or written form. So let's get into it. This week's newsletter is really going to be more of a broad look at what to look for as we close out 2025 and head into 2026. So as far as trading for these next few weeks goes, or next couple weeks really, we have Christmas this upcoming week, we have New Year's the week after. And so, as we normally run this newsletter looking at the week ahead, to tackle that real fast, obviously this is our S&P index year to date. So we can see what it has done so far for the year. There we go. There's our exact year to date. And so been a pretty impressive market with, April downturn and then subsequent recovery. But let's go ahead and just address the next couple weeks if you're really itching to trade, which I wouldn't recommend, honestly, because again, with the holidays, we're expecting much lower volumes. We talked about this range. If you are subscribed to the newsletter and read last week's newsletter, pretty much been trading in this large range between the 6520s to 6900s, with 6750 really being a midpoint. And certainly, coming off of last week, we had this downturn here and, a little bounce right at the midpoint, but not a whole lot of action going on here and pretty low volume in these past couple weeks. So I would expect that to continue. More range bound, low volume activity, not as a whole lot of predictability in the markets. You see, these few days here, we got this big red candle here, kind of these weird green candles jumping up, doji here, hammer, doji. It's kind of a mess right now. And that's what I would expect for the next couple weeks. Again, just low volume. Traders are taking off for the holidays. Investment banks are taking off for the holidays. So really wouldn't recommend focusing too much on short-term trades in these next couple weeks. But now looking ahead into the market outlook for 2026, what I'm going to do is outline some things we can expect for the positive expectation of the market in 2026, and some things to look out for that could potentially lead us to correction territory in 2026. And then we're also going to end with some just investment allocation recommendations. So let's go through that here. Okay, so for economic and market drivers, number one, looking into the next year, we're going to be looking at corporate earnings. So, and this outlook that I've put together, by the way, is based off of, the larger consensus of a wide variety of analyst reports from all different Wall Street banks, and, really reading what all of them have to say and sort of making a conglomeration of them, and coming up with my own interpretation as well. But, most analysts are expecting positive corporate earnings in 2026, and that's going to be fueled by the productivity gains from AI. And also under Trump and the big beautiful bill, corporate tax incentives, which are expected to really positively affect corporate earnings heading into 2026. That's going to be expected to be a driver of market returns, and so we'll be looking for that as we look into the first quarter earnings heading into 2026. Okay, AI. So this is the big. Obviously, I'm going to sound like I'm parroting every market commentator or headline out there. But this entire market has really been driven by the hype around AI. And the biggest thing to look for in 2026 with AI is getting away from the hype and the actual realization and implementation of AI. Because there's been massive capital expenditures from corporations. Think Google, Nvidia, Apple, Microsoft. All these big companies have been pouring tons and tons of money into data centers and semiconductors. And there's this race going on between U.S. and China for who can really be the leader in AI. This is causing a lot of spending across the board in AI and lots of investments, which has up to this point really caused a lot of hype in the market. We need to see this translate into tangible productivity improvements across various industries, right? And where we're going to see that a lot, where we're going to see that primarily first is going to be in the industries of technology, communications, and even healthcare. How are we going to look at those companies in those sectors? And those sectors really do make up a lot of the S&P 500, especially technology. But, when we're looking at these company earnings, how are they being benefited by AI? How are the companies realizing a return on their spending in, investing in AI and data centers? How is that making companies more productive? That's going to be a huge element going into 2026. Next is monetary policy. So the Federal Reserve has been in an easing cycle. We just got a rate cut on December 10th. That was actually my birthday, so you're welcome. That was my birthday wish, was another Fed rate cut. So, and we got it. So, and we're expecting to continue easing interest rates. So that's going to be supported by, and we talk about this every week in our newsletters. So again, make sure you're subscribed to the link in the description on the Substack, because I'm usually writing this in your emails. We always look at, the economic data coming out, whether it be inflation markers and labor market numbers. And what I always keep saying is we actually want to see a cooling labor market. That means, the labor market reports are showing, that maybe things are not good. Bad news is good news, because that is going to continue to support the narrative for the Federal Reserve to cut rates, and that is positive for the market. Now, we're going to talk about headwinds on the next slide and how inflation can get in the way of that, and that's a risk to look out for. But lower rates are generally going to be good for risk on assets, and so we're going to be continuing to watch the labor market data, the Federal Reserve expecting to support that, and we're also going to look out for inflation, which we'll talk about in a moment. But the last item here for market drivers is going to be fiscal policy. So as I mentioned before, this administration, and politics aside, it's bullish for corporations. There's tax incentives, capital depreciation allowances for businesses and for consumers, which is going to add support to ultimately to GDP growth, which is really going to be something that we need to support stocks continuing to go higher. Because you hear people talking about, the market being expensive. What does that mean? That means the market's trading at a high valuation relative to our GDP growth. And so what we're going to need to see in 2026 is GDP continuing to grow, the actual economy continuing to grow in order to support the market to continue to trade at these valuations, right? Now let's look at some risks. What should we be watching out for in 2026? Of course, inflation. I alluded to this earlier. So we always look at, there are Tuesday and Thursday and Friday reports when they come out, the economic indicators, and I talk about the labor market, I talk about inflation. Inflation, we really wanted to see it coming down. We want to see it stable and decreasing. If inflation is sticky, that can start to make things tough for the Fed to continue to lower rates. And if inflation is too high, the Fed may pause rate cuts, which could put pressure on markets. And it could put pressure on the labor market as well. So again, we really want to see inflation not be sticky. We want to see it decrease. We want to see it come back to target. And we're going to be watching those economic reports. And again, I go over those every week in this newsletter. But that's going to be a major factor. And we talked about the Fed, their balance, their dual mandate is to, one, support the labor market, but two, control towards inflation. And they don't want to let either of those get out of hand, but they're kind of two opposite sides of the seesaw. So another thing that might also help with reducing inflation is actually the implementation of AI. That ties back to our previous point. If companies can do things cheaper, if we can reduce the cost of goods through the cost savings of AI, that can also help to tame inflation. Okay, another key risk is market concentration. So again, you've heard this in every report, but this market has been driven by just a handful of mega cap stocks, the Magnificent Seven, and stock valuations are high. So what could be a headwinds to look out for in 2026 is if these big mega cap companies that are really leading the market start to crack a little bit, if their earnings start to slow down, start to show slowing momentum, right? And that could cause things to deflate. And that's why I personally think that, it's very possible, and in fact, I would even say probable, that we see a correction in 2026 at some point, a market correction. Now, just to be clear, market correction is not a bear market. It's not a recession. A market correction technically is defined as a 10% drop in the market. A 10% pullback would happen, and I believe that would be triggered by some of these AI companies and the Magnificent Seven starting to disappoint on earnings. That could cue our 2026 market correction. So I would be looking out for that. And I think that's very probable in 2026. Not to say that we don't end the year higher, not to say that the majority of the year we don't add gains to the market, but I definitely think, and this would be the key thing to look out for to trigger it, but I definitely think a normal 10% market correction would be absolutely actually healthy and needed right now, but very probable in 2026. Again, not forecasting a recession or a bear market. That would be defined as a 20% drop in the market. Just to be clear, but 10% correction, definitely probable. Okay, another risk and headwind, geopolitical and trade tensions. We've seen this throughout 2025 with the US and China and Trump and that whole debacle. So we want to continue to be, monitoring for that and having that on our radar as we head into 2026. What's going to happen between U.S. and China? That could create some volatility in the market. Tariffs. Trump doing new things all the time with regarding the tariff environment. That could definitely cause some volatility into 2026, just as it has in 2025. All right, so recession risk. Most of the major banks, the one I work at, as well as many others, are assigning roughly, a 35% probability of recession, and that's just because, right, there has to be some probability, right? The probability is not zero, but what should we look for to start thinking, okay, maybe the odds of recession are increasing? That's going to be our cyclical weakening, right? So we have our defensive industries that are not cyclical, right? And that's going to be things like utilities, where people need them regardless. Things like pharmaceuticals as well, non-cyclical. People are going to need those all the time, no matter if markets are good or markets are bad. Cyclical industries are what we're going to be looking at. That's going to be your darlings of the day, right? The stocks everyone's talking about. If we get some weakening in those, and a shift in the business cycle towards more defensive industries, then that could be starting to increase the probability of recession in 2026. So what should we do? Well, of course, number one, diversification, right? So when you think about just coming off of that point about the cyclical, and one thing that I own in my portfolio is both value and growth, right? And I own these through just ETFs, diversified ETFs. But I have value stocks and I have growth stocks, because even when our growth stocks are going down and the headlines are reporting, oh, S&P is down, oh, Nasdaq's down. Well, some of those stocks within the S&P and Nasdaq are actually up. And those might be your value stocks. So what happens often is a rotation between growth and value. It's important to diversify across the board and own both of those, right? As well as international. And those are more, international stocks as well are more attractively valued and have strong growth potential. So when we think about some of the international companies getting away from our Magnificent Seven, some of those are trading at much lower valuations, which can be attractive. Okay, fixed income. So as the Federal Reserve is expected to continue to lower rates, what happens when rates go down? Bond prices go up, right? It's an inverse relationship, because, of course, if I have a 5% bond and then the rates go down to 4%, well, how much more valuable now is my 5% bond to you? You can't get them anymore. So buying bonds now, and it could be profitable, not only because you're locking in higher rates now, but also because as rates come down, you're getting the additional benefit of that capital appreciation of the price of the bond itself, right? And we're going to focus on high quality corporate and government bonds in that. Sectors. So again, we mentioned this a little bit earlier, but the sectors that are expected to perform the best due to AI are going to be technology, communication, and healthcare. It mentions industrials and utilities in there as well, but I would say mainly those three are the big three: technology, communications, and healthcare. Those are going to be again, removing the hype from AI and getting in towards actual implementation, right? These are the industries going to be most affected. Okay, and alternatives. So owning some assets that are completely separate from this whole AI boom is going to be really beneficial, and specifically real assets. What are real assets? Things like commodities, gold, real estate, and even private equity. Those can really help balance out your portfolio in 2026, and are also expected to increase as well, because as the Fed lowers rates, again, that is bullish for real assets such as commodities, real estate, and other private markets as well. Because when we think about lower rates, that causes the value of things like the dollar to go down, but assets, and especially real assets like our precious metals, we've seen gold do tremendous in 2025. That could continue as the value of fiat currencies decrease. So that's all I had for today. I really hope you enjoyed this video. Let me know in the comments what you got out of it. And don't forget to like, comment, and subscribe. And that's it for 2025. So again, I will see you in 2026 with a brand new market newsletter. But these are some things to look out for as we head into the new year. And I will see you there. Like, comment, subscribe to the channel, and subscribe to the free weekly market newsletter that I do, sent to your email inbox every week. All right, I'll see you guys.